Paul, and I'm from Michigan Technological University. Well, I have experience analyzing securities before, but one thing that I haven't had a chance to do is interact with both the company and also other professionals in the industry. So it was a really great experience because communication is everything, and learning how to clearly communicate with other industry professionals is completely invaluable. The biggest challenge was definitely Parago. They had a broad scope, and they had a variety of segments, and learning how each of those worked, especially within such a complex industry, was one of the biggest challenges. I think the challenge reflected what analysts work with in the real world. It was great to see all the intricate parts of actually working with a real company and seeing how all those pieces fit together. One of the nicest things about the challenge as far as my future career goals is that it really solidified the fact that I chose the right course of study, and that this is finances industry that I really want to go into for my career.
Good morning. My name is Eli Cartman, and on behalf of the entire student research team from Michigan Technological University, we're very pleased to be here and present our strong buy recommendation on Parago. Over the past 4 months, we've performed an extensive company analysis, and we'll be sharing that with you here, and we're very pleased to do so. Let's now introduce the research team.
My name is Anna Paul.
Again, Eli Cartman.
I'm Jessica Zeike.
And I'm Justin Wilson.
Alrighty, here we present our overview of our investment strategy and buy recommendation for Parago with a target price of $126.80, generating a 22.1% premium from the day which the analysis was calculated. Our premium is based on 4 pillars of success for Parago, and those are the business model that they've showed historically has been successful, as well as sustainable growth factors moving forward, along with very low anticipated risk for the firm, along with a very positive industry environment as well. And so we see that historically the senior management team at Parago has been very proactive in releasing new products, as well as expanding through merger and acquisition activity, and also entering new markets. So we're confident in their ability moving forward to help us reach these pillars that support our buy recommendation. And Anna is going to talk a little bit more with us here about the industry component of this.
So the future looks bright for Parago, and so does the outlook for the healthcare and generic pharmaceutical sectors. In the United States, healthcare spending has seen consistent growth over the past few decades, funded by technological advances, longer life expectancies, and an aging population. Increased market share by generics and store brands during the recent recession have led to increased and continued consumer loyalty. In addition, the expiration of a large number of branded pharmaceutical patents in the recent and upcoming months will provide exciting opportunities for Parago. Internationally, an increased demand for healthcare is not being met by an adequate supply internally. Parago operates through wholly operated subsidiaries, both domestically and internationally. As you can see, Parago already has positions in India and China. These resources and positions have allowed them to continue their trend of acquisitions and organic growth, as Parago is poised to further penetrate these markets. Even stable companies have certain risks, and Parago is no exception, although we believe that they will manage these risks well. Strong corporate government and social responsibility philosophies manage exposure to quality control issues. Their size, product diversity, and strong business fundamentals help maintain competitiveness. Currently, there are no pressing issues with the supply of raw materials or unrest in any of the locations of their subsidiaries that would hinder production. And going into our revenue model, we based our revenue model on company historical time series data that is augmented with qualitative adjustments gathered from Bloomberg, the company's 10K and releases, and other forward-looking statements. In order to gain a firm understanding of Perrigo's growth, we broke this revenue into segments. We expect to see strong continued growth in the consumer healthcare and prescription pharmaceutical segments. We attribute this to the continued release of new products, the trend of retailers creating their own private label brands, and the increasing number of drugs that are shifting from prescription to over-the-counter and generics. The nutritionals, active pharmaceutical ingredients, and other segments make up a smaller portion of Perrigo's total revenue. Although we expect to see growth in these segments, we do not have evidence that these will exceed historical patterns that we have seen in the past. I'll now pass it back to Eli, who will continue to talk about our financial analysis.
Excellent. As a proxy for our income statement, on this slide we present a basic earnings per share data, which you can see, with the exception of 2005, the company has been able to generate a positive earnings per share value with a continuing growth moving forward. Based on our projections of the financial statements and Anna's, as she mentioned earlier, the revenue estimates, we see that earnings per share estimate will continue in the positive trend in the future, as you can see here. Also on this slide, we've presented a common size net income, which seeks to adjust for the size of the firm as it continues to grow. So we take net income and divide it by total revenue, and we present this common size value here. So we see that Perrigo's growth in income moving forward will not only come on a nominal basis, but also in a size-adjusted one as well. Moving on to the statement of cash flows here, we see that moving forward, larger changes in their cash position will occur based on the revenue estimates Anna mentioned earlier, growing and relatively steady dividend policy as well as capital expenditure procedures as the company executives had priorly mentioned, seeing not much change in that. We do see significant increases in operating activity cash flows, which is presented herein. Moving on to financial ratios, we've done a 5-component DuPont analysis of Perrigo to break down their return on equity, which we can see is significantly above competitors such as Watson Pharmaceuticals and Teva, as well as the industry average. Here we see that their outperformance on return on equity is not isolated to one good metric, but is seen throughout the 5 components significantly. And that highlights the strong fundamentals of Perrigo as a company-wide basis and supports our strong business model moving forward. I'll now have Jess talk a little bit about valuation.
Thank you, Eli. Our target price was based explicitly on 2 valuation methods, taking into account a relative valuation method as well that Justin will go into a little more into detail. We decided to weight the free cash flow to equity at 67%, as we felt that this was the most appropriate form of valuation at this time for Perrigo. Using these valuation techniques, we developed a target price of $126.80 with a 22.1% premium, as Eli had stated previously. We are extremely confident in this target price and believe that it's indicative of the future performance of Perrigo going forward. The discounted free cash flow to equity valuation approach seeks to value Perrigo stock as the present value of the future free cash flows, which will inevitably be paid out as dividends if not reinvested or retained in the firm. Over the long run, all free cash flow will be paid out to equity holders while accounting for the time value of money. This method is based on forecasted financials and the overall growth of Perrigo, using a cost of equity of 8.83% and a perpetual growth of 2%. And I would like to now point your attention to the sensitivity analysis. We believe that Perrigo is well positioned in our targeted price of $126.80, and we believe that's a conservative estimate, but a strong estimate as well. Justin will now continue into relative valuation techniques.
Thank you, Jessica. As you can see here, we have used 4 common comparative metrics: price to sales, price to cash flow, price to earnings, and price to book ratio for Perrigo against its competitors as listed by Bloomberg. Perrigo competes favorably in each of these areas. On the price to sales ratio, you can see that it is below the industry average. This is indicative of future growth possibilities. For the price to sales, price to earnings, and price to book ratio, you'll notice they're slightly above the industry average. We attribute this to the product lines that vary from Perigo to its competitors. Perigo's core values, respect, integrity, and responsibility, each have shaped their corporate and social responsibility policies. Policies aim to protect human rights, the customer, and the environment. I would now like to direct you to Eli with our investment summary.
Thank you, Justin. So throughout this morning's presentation, we provided some information to you as to why we are so confident in our buy recommendation on Perigo, and whether it's looking at Jess's valuation discussion or Anna's growth in revenue. It seems that the target price of $126.80 is a very conservative and very manageable estimate for Perigo moving forward, but it also provides significant room for investors to generate a premium of 20% for both large and small investors. And so we're very pleased to have had this opportunity to present this to you today, and we thank you very much for that opportunity.
Can you talk a little bit about, you mentioned you used Bloomberg company comparisons. Do you know which companies those were?
Yeah, if we go back to the
challenges you may have in finding a comparable company for Perigo.
Well, that was one thing that was a little bit tricky, because a lot of times they have one of their main competitors are different across their different products line, because they have such diverse products. We actually used Bloomberg's, and a lot of these were also listed in their 10K. So we tried to use the companies that both Perigo identified and other sources of industry information, such as Bloomberg, as our competitors.
Can you touch just a little bit on how they're growing organically versus inorganically?
Yeah, we actually see strong growth both organically and inorganically. We see a strong research and development. In fact, Perigo themselves said in an investor relations meeting that they have their best and strongest research and development that they've had before, as well as their capital expenditure, and they just opened a brand new center in Michigan. As well as we see a strong pattern of acquisitions, both nationally and internationally, as well as in some of these new emerging markets. So I don't think, do we have the...
Yeah, I think I mentioned previously that the capital expenditures in mergers and acquisitions is continue to expand at this, or is to continue on at the same pace that we've seen historically. Perigo's growth has been largely attributable to the inorganic growth through those acquisitions, and we expect that to continue as it's part of their company culture to do that.
Would you anticipate those acquisitions to be in one division of the company perhaps more than another? Are they trying to emphasize growth in one area or another at this point?
Our revenue model supports primarily consumer health care, and I think that's the recent pattern that we've seen, although I'm sure if Perigo saw an opportunity within any of their other segments, they would definitely take advantage of that.
In your longer term model of the earnings, you see that there was a big drop off in 2005, but the trend from 04 to 07 was generally negative for the earnings, and then all of a sudden in 08 they picked up. What's your sense of what changed? What was the problem and how did they fix it?
I think Perigo's continuing to assert themselves as a company, and they're being able to be very confident in the way that they manage, and they're doing strong acquisitions and launching strong products. Since 2008, we've seen a change in consumer preferences with respect to generic pharmaceuticals as a whole, and they've benefited from that significantly with consumers choosing store brands over the generics. We see that with regard to the data on that. So I think a little bit in changes in consumer preferences, but also that emphasis of Perigo's continued success has led to this earnings per share trend that we've seen lately. If we look the amount for 2012, in most recent years since the economic downturn of 08, we have seen growth in that earnings per share, which would be illustrated by the points I mentioned.
Can you talk a little bit about in the consumer health care segment, type of customers they have? Are there any large customers or sort of broad range of customers? Is there a risk there of losing one account? And what kind of market share they have? Is there competition they have to worry about?
I believe that a big customer of them is Walmart. They are attributed to most of the sales of Perrigo. At this time, we don't feel that that's risky for them because they have established themselves as a strong customer, and I believe that's going to be the case going forward as well.
The revenue model chart that you have where you look at fiscal year 2012 versus the estimate of 2016, if you looked at that from 08 to 12, what were the big differences? What were the drivers, the changes?
Oh,
Yeah, we broke it down by segment here as well, so we can take a look at 08 and to go to 12, we can see significant growth in nutritionals as the nutritionals revenue segment was implemented very recently. We also see growth since then in the prescription pharmaceuticals as well, and that's another trend that we expect to continue.
What's the risk profile in the pharmaceutical business relative to the consumer healthcare business that they've traditionally been in?
It is a little bit riskier. It does have some higher barriers to entry, especially concerning, although both are regulated by the FDA, there certainly is, it often costs more to go into these two, and no guarantee that they'll get approval from the FDA, where with a lot of their consumer health care and those sort of things, there's already products in the market that have been approved that they can sort of duplicate. So that does create a new sort of risk for them as they increase that business.
You talk about the quality management and their efforts to attract and retain quality management, and then also in this model of acquisitions, when they acquire a company, they make an effort to keep current management on. What incentives they may have?
As far as we are aware and from what we have heard from the company, they have managed to integrate each of their organizations as wholly owned and operated subsidiaries, including their locations in Israel and China, and they managed to do so by keeping employees happy and having a great company culture.
However, there is always implementations. I know in 2000 there was a recall at FDA, and Joe Papa made a statement about how they would be moving forward with that, and they have even recently been talking about how they've been doing things such as adding iPads and other things in, and new measures of quality control, and those can be implemented into their new acquisitions without completely changing those cultures.
You mentioned that free cash flow was the best method of valuation today. Why is that?
We feel that it is the best valuation technique at this time because we do feel that it's a stable company, and we feel that there's going to be consistent growth as we stated in our financial statements. We believe that the 2% growth rate is going to be consistent going into the future.
Yeah, also the firm's management of debt allows us pretty easily, or pretty, what I'm going to say is accurately into the future estimate what cash flows will be available to equity, and over the long term, the free cash flows to equity have been taken into account here, and I think that the stability of this model allows us for a better estimate than other valuation methods.
Can you talk a little bit about regulation risk, and if there is some out there, what it would be?
Oh, okay. These are extremely highly regulated. Obviously, these are products that people take into their bodies. And one of the things that we saw, especially during our company tour, was a high level of adherence to regulations, and definitely an effort to make sure that they were always keeping up to code. Despite these regulation risks, Perrigo doesn't have or hasn't recently had any problems with FDA regulations, and we believe that their strong corporate governance and social responsibility philosophies have led them to continue that trend.
The expansion of the profit margin over the past few years, you You think that's sustainable, and why?
I think that, moving forward, they have been able to expand their profit margin, and in the future, it eventually has to taper off. We can't continue growth like that forever, and I think that's taken into account somewhat here. But I do think that the current level of profit margins is sustainable to them to some extent. Can we go to the DuPont analysis slide just to look at that, to illustrate that point here. So if we look at this profit margin, it is above industry averages significantly. So yeah, there is probably likely some tapering off in their profit margins, but I do expect them to be able to remain above their industry averages for sure.
You did a relative valuation analysis. Which one of those do you think was most relevant? You didn't include it in your estimate of value. Imagine you just did this like as a cross-check.
Yeah.
Which one of those is most relevant?
Personally, we believe that price to cash flow is most relevant in this case, as we found that their cash flows will be growing in the future, as Eli said earlier, and their price, although relatively high, has been very supplemented by their very large cash flows and growing cash flows. So that ratio is very indicative of their future possibilities for growth. And I believe that that is what we were trying to illustrate by it.
Thanks.
Thank you very
Thank you.
much.
Thank you very much.